Hello, everyone. My name is Dan Capek, and my teammates are Sean Anise, Alyssa Kaplan, and Gardner Marks. This semester, our team covered Callon Petroleum Company with the Burken Road reports at Tulane University's A.B. Freeman School of Business in New Orleans, Louisiana. In this presentation, we are going to discuss Callon Petroleum, which is an independent oil and gas exploration and production company headquartered in Natchez, Mississippi. We will start out by giving you an overview of Callon and its corporate strategy, followed by a discussion of the recent developments within the petroleum industry and risks inherent to the industry. Then, we will provide a brief analysis of Callon's latest SEC filings and our team's valuation of the company. Finally, we will conclude our presentation with our investment thesis and 12-month target price and performance projections. So, let's begin. Callon Petroleum produces, explores, acquires, and develops crude oil and natural gas properties offshore in the U.S. Gulf of Mexico region and onshore in the Permian Basin and Haynesville Shale. Callon's market cap is just under $140 million, and since its inception, the company has utilized efficient operations and low finding and development costs to build reserves and production both onshore and offshore. The company has a P/E ratio of 5.23 times and approximately 92 cents in earnings per share. Callon's oil to gas ratio is approximately 60% oil to 40% natural gas as of December 31st, 2010. In 2009, Callon initiated a corporate strategy for reinvesting the substantial cash flow generated by its offshore producing properties into lower risk, longer life onshore oil and natural gas fields. Callon began carrying out this initiative by making strategic acquisitions in the Permian Basin of West Texas and the Haynesville Shale of northern Louisiana. By year-end 2010, Callon expanded its onshore proved reserves to 50% of its total proved reserves, which is up from just 16% at year-end 2009 and 0 at year-end 2008. Furthermore, Callon's third quarter filing in 2011 showed that Callon increased its onshore oil production in the Permian Basin by more than 135% since December 31st, 2010. Callon operates within the exploration and production segment of the petroleum industry. In this industry, profits depend on the price for oil and gas, which are subject to supply and demand forces in the commodity markets in addition to cyclical factors. The industry is extremely competitive and the barriers to entry are high. Early in 2011, oil prices reached their highest level since 2008 because of political unrest in Libya, the Middle East, and North Africa. More recently, geopolitical unrest in major oil-producing nations caused oil prices to remain high. However, the structural oversupply in natural gas markets continues to weigh on spot prices for natural gas, and many analysts are expecting drilling activity for natural gas in the U.S. to decrease as a result. There are several risks characteristic of the exploration and production industry that all companies operating within this industry are exposed to. The relatively weak state of the global capital markets is a source of concern for companies operating in the oil and gas industry because a decrease in the demand for commodities would depress the prices for oil and natural gas. High reserve replacement needs for properties in the Gulf of Mexico is another risk because production and cash flows will decrease unless companies can either acquire properties with proved reserves or conduct successful exploration activities. The industry is also subject to several regulatory risks. In particular, financial reform legislation concerning derivative contracts may make it difficult for companies to hedge exposure to commodity price volatility. Furthermore, legislative initiatives calling for federal regulation of hydraulic fracturing could pose additional operating restrictions. As demonstrated by Callon's recent SEC filings, the company's financial position continues to improve and its earning growth is accelerating. Successful onshore operations in the Permian Basin and the Haynesville Shale, along with cash flows generated from offshore operations in the Gulf of Mexico, allowed Callon to post a net income of $8,386,000 for year-end 2010. In the third quarter of 2011, Callon Petroleum reported net income of $8.4 million, which was a remarkable increase over third quarter earnings for 2010 when Callon reported net income of $1.6 million. In 2010 and early 2011, Callon made great strides in strengthening its balance sheet and improving the company's overall liquidity position. Callon strengthened its balance sheet significantly in February 2011 when the company raised $73.8 million in net proceeds from a common stock follow-on offering. As a result, Callon was able to reduce its total debt outstanding to $107 million, which represents a 162% decrease from a face value amount of total debt outstanding at year end 2008. This debt reduction also lowers the company's annual interest expenses by approximately $4 million through 2016. Notably, Callon also increased its cash position by approximately 177% from fiscal year end 2010 through September 30th, 2011. We believe Callon's stock is currently trading at a significant discount to its intrinsic value, and we are confident in Callon's ability to improve its position relative to its peers in the industry. We feel that Callon's ongoing commitment to its profitable offshore to onshore asset conversion will continue to benefit the company's profitability. We expect Callon to continue on its remarkable growth trajectory because the company still has the ability to access prospective onshore sites that could be sustainable for several years. The company's results for the third quarter of 2011 illustrate that Callon's onshore development program is progressing according to plan, and Callon's offshore properties in the Gulf of Mexico are continuing to deliver strong returns. We view adding acreage in the Permian Basin as the biggest challenge facing Callon because growing competition for acquisitions has increased the cost and availability of properties significantly. However, we believe that Callon has the liquidity to support the company's growth plan and will continue to improve its already stable financial position. Now that you have a better grasp on the current state of the company, we will now discuss the valuation methods we utilized in arriving at our 12-month target price. Our 12-month target price is based upon a weighted average of the results from three different valuation methods: discounted cash flow, PV10, and price to book value. We decided to use three different methods to arrive at our target price because each method evaluates Callon from a different perspective. The discounted cash flow method evaluates Callon's revenues, which are driven by our estimated production levels, oil, and gas prices. The PV10 estimates the present value of Callon's future oil and gas revenues, net of estimated direct expenses, using a 10% discount rate. This valuation method essentially estimates the value of a company's current reserves versus the discounted cash flow's valuation of projected production. Lastly, we use price to book value in order to estimate the value of Callon's assets based on an average multiple determined by the company's peer group. We felt it was important to incorporate this valuation technique because Callon's assets are such a vital part of the company, and this method allowed us to take Callon's peer group into account. After weighting the valuation results from each of the three methods, we determined our 12-month target price to be approximately $6. We strongly believe that Callon is well positioned to generate attractive returns and outperform the market over the next 12 months. Our 12-month target price of approximately $6 represents a 28.48% premium to Callon's closing price on November 21st, 2011 of $4.67 per share. Although certain risks are inherent to E&P companies, and investors must be mindful of the risks associated with investing in relatively volatile stocks, we feel that Callon's proven management team and promising strategic initiatives will generate very attractive returns for investors. We hope that you enjoyed our presentation and received valuable insight on Callon Petroleum. Thank you for your time, and please feel free to contact any of our team members with any further questions. The Brickenrow Reports videos are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The videos are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.